Yeah. So how have you been since last week, and what prompted you to book this call? What can I
Yeah,
do?
I've been busy. Yeah, I sent an email out yesterday to you with some passive opportunities.
Hmm.
Um, and you sent an email back saying uh, we wanted to discuss the first one.
Oh yes, yes, yes. That's right. Yeah. I did. I'm fairly strict on the underwriting, and I always imagine the worst. It's kind of what you have to do. It's like what Abraham teaches. So I imagined that everything went wrong and that I'm first position and I have to foreclose and we have to do a fire sale. So with that in mind, it didn't quite look like a deal when I looked at it like that. So I'm wondering if you could go with the figures and show me what you think. Maybe there's something I've missed.
Gotcha. Um, yeah, kind of. Oh, I don't have the ability to share. I just pulled up what I emailed over yesterday. um, Subject to deal. Um, so I
Yeah.
would
And I
expect.
remember I remember he was in foreclosure and you caught them up, is that right? And everything. Yes.
Correct. Yep. So, um, taking it over subject two, um, gosh, we have roughly about 120,000 in equity in the property. Our crew that we use here on
Okay. Can I
for
pause you there? Let's establish that first. So you say 120 in equity. How are you arriving at that figure? Is it the as is or the repaired value that you're referring to?
we're talking repaired value
Okay.
on a standpoint compared to the actual current loan balance.
Okay,
Um,
so when we buy properties, when I enter into a deal, we don't do the ARV because that's a future thing. It may never happen. So we have to do it right now because a disaster might happen. Like we've just had Hurricane Helene, right, come through. There's any number of disasters that can happen, and the repaired value may never happen for one reason or another. So we have to look at things when they go wrong and establish the figures on that. So we get to a point where we're comfortable in doing the deal and almost pray that it goes wrong because we end up with the property. So it's loan to own. That's a first position mentality, where you don't lose, you see. So we have to take the as is value right now. Is he making his monthly payments or are you making the monthly payments right now?
he's making his monthly payments as
Okay.
of current. So, um, yeah, I mean, I completely understand the perspective of worst case scenario. I think I'm big on that as well.
Yeah.
Obviously,
Absolutely.
it's real estate. That always seems to be about a 50-50 chance whether it's good or bad.
Right.
Um, I
Right.
do think that's where when you say disasters, that's where insurance comes in. So, uh,
Well, yeah, sometimes not. Yeah. I mean, I've just had my own property damaged. They only pay 25% of my losses.
hmm.
Yeah.
Yeah, I mean we're in Indiana, so no worries about a hurricane. I guess that's the
That's
benefit of
good.
being up here.
That's yeah.
um, Nor tornadoes or nothing. The worst thing is maybe some snow takes your gutter down,
Okay.
or a fire, or a
Or a
fire. I mean
fire. Yeah. Yeah.
that's usually up here. That's the greatest risk.
Yeah.
Outside of that, I mean, yeah, I think that's a good perspective to look at it as far as is value to loan value. I still
Yeah.
think it's very healthy. Um,
And
it's
that's
a
how hard money lenders do it as well. They'll do the as is value. Right.
Yeah, that's their LTV. I mean, they're
Yeah.
looking to do a loan to value ratio, um,
Yes. Yeah.
due to the fact that it's a subject to deal. It's a little. I mean, yeah, I think you can look at it from both ways. I think you can look at it a straightforward way when you're looking at okay loan to value, but on that case, it's on a subject to your LTV is really my loan to value ratio of coming in and what mortgage I'm taking over. Does that meet almost that criteria since we're not replacing a mortgage? Um, and that's why I think our simple interest rate on it was so high as well, due to consider a loan position being in second instead of first on a
Yeah.
sub two.
And remind me
Um,
on the percentage on that mortgage. What was the percentage on that?
our simple interest for the balance we requested was 30%.
No, no, no. The loan that we're taking over. What percentage on was that?
The loan that's currently in place, and if we want to be conservative, I mean it's very cosmetic. I mean the property's just it's old. I mean it's what we use old carpet, old floors, old
Right,
paint.
right.
Nothing major in the aspect. I think the only
Mm,
major thing at this property is the deck. You know, just doing a resurface. That's probably
right.
the ugliest.
Yeah.
Um, so it'd be great. Your ARVs, and I believe the comps that we provided in there were super healthy. Um, but I don't know. What do you feel? Maybe I should just shave off 50,000 off the top. See what that gives us. So we're at like a 275.
Yeah, your comps were good, but remember when we're looking at the worst case scenario, we're not going to get 100% retail. It's a fire sale, so an investor will pick it up. So we're not, we do 70% to do a fire sale. We do the as is minus the 30% to cover our losses, attorney fees, and what have you.
We're at about a 75% LTV on that current loan that's in place to the actual value. If the value was
Right,
for
right,
say 275, which
right. And you're
would be at
close.
an extreme discount.
Right, right. It is close. And on the mortgage itself, what is it? What's the percentage on the mortgage?
His
Oh,
interest.
yeah, it's interest, right. What was that?
Oh, he bought this in 19. I believe it's like a 3.6%
Okay.
interest that he's carrying out on a VA loan.
Yeah. Okay. That's good. Yeah. Very good. Yeah. So it's just, as I say, it's just a little tight. Yeah, nothing has really changed from what you said. So, we've got to take the in the neighborhood where we look at the range of prices as well, so um because it would be a distressed situation if the worst happened, you've got to take the bottom of the range to get it sold and recover your money. And that's how
I
we underwrite it, you see. So
Gotcha. I
um
don't think the property's in a necessarily distressed state. I think the seller's in a distressed state, but I would not classify the property as being
oh
distressed
no,
by any
I
means.
I understand, but it would be a distressed situation because we need to sell it to recover our money if the worst should happen, you see. Do you see what
Yeah,
I'm
I,
saying? I'm
I'm,
just giving you the
I'm,
mentality of how risky is the position, you see. So we have to take the more extreme value when we lend money, so that, as I say, we're more than happy to loan to own. The whole overriding thing is loan to own. Right. So if the worst goes wrong, we get the property, we can recover our money.
Gotcha. Yeah, I'm not following. Just to be completely straightforward with you, I guess I'm not following that mentality. I understand if this was a hard money loan. Even then, I'm still. I think even from a hard money perspective, if we're going to look at it that way, it's still even under their parameters. I mean, most hard money lenders are an 80% LTV. Um, Smaller private money lenders, I would say, are maybe around that 75, which we still even meet that criteria.
Yeah.
From a loan to own perspective, I think it still falls within those parameters very well. Um, I guess say worst case scenario, loan the money, it gets recorded. This we take this property over within 30 days, say, and now we need a fire sale this thing off. Um, you're all in at that point would be like a 235, and I was very conservative when I said that as is 275. I mean, I just cut off 50,000 just for the absolute extreme,
Hmm.
um, which in that case is an extreme.
Hmm. Okay. All right. Yeah.
So
Well,
that's the only reason why I guess I'm trying to understand a little bit better from what perspective you're looking at it. I'm always open to taking that perspective into consideration, just trying to make sense of it.
yeah. Sure. Sure. I know, and we get different perspective for those who's putting the money out there from those who are the acquisition. So you obviously you're like the seller in that sense. You want to put the best spin on it. When we're putting the money out, we've got to put the worst spin on it. To make sure our money's safe. 'Cause
Gotcha.
the only reason we're putting the money out is to make money, right? You know,
Yeah, and that's and
yeah,
I completely understand that perspective. I guess I'm trying to understand. I think from my perspective, I shaved off 50,000, so I'm just trying to kind of wrap my head around like that is the worst case.
mm, yeah,
It is a subject to deal that you're taking over a house as a whole with the deed.
yeah,
Um, and I think that's why, even let's look at a hard money perspective. I mean, your 10 to 12% is what they're looking to make on their money.
mm,
Um, that's even in a first position. I do understand that if, hey, we're taking it over subject to, there's going to be a VA loan in first, we'd be in second. I mean, that's why you're almost at like a 3x at that point on a 30% simple interest.
mm,
Um, that's the gap between private money in that position compared to even just a hard money loan. And I'm simply looking at it from a hard money perspective at this point because yeah, I think of anybody that lends money, they're always in that loan to own
mm.
model more than any lender that's out there.
That's right. Yes, that's right. Yeah. Well, thank you for going over that. Uh, I'll probably take a deeper dive and look at that and see how I feel about that and go from there. Have you had other interests on it?
Yeah, I have one other. Pace sent me yesterday. Name's Tim. Um, he's located over near Indiana though. He's an Ohio physician, so
Mm,
um, honestly, that's why this was drafted the way it was. I know from our first call, I kind of ran you through how I got in contact with you with Pace sharing that information.
right.
Same scenario, reached out, scheduled a call with Tim. He kind of ran me through like, hey, if you're going to do subject to deals, we're going to want to see 30%, 25 to 30% on a simple interest due to the risk involved with substantial equity. Um, so that's why it's drafted. It was kind of drafted to cater to that perspective, which all the numbers still made sense. I mean,
Mm,
from our perspective, we could offer and this isn't our first. I mean, we've done over 200 deals, so it's not like it's our first go around.
mm.
Um, but we can offer a 30% at the end of the day. Investors make their money, and we still are left over with a healthy profit. I mean, we're almost at a 55,000 profit. Worst case scenario, our profit goes away. A private investor would still be pretty comfortable.
I like that perspective, and I like that you've got experience. I can tell that you're solid on that, and I was impressed with your comps seem good. So, um, and of course, a lot of it for me personally, I'm 63, you see. So when I'm going to do these deals, I'm less a risk tolerant than I used to be, 20 years ago. So I've got to look at the blackest I can so that I'm happy with the outcome, you see. So um yeah, because it is if I did this deal, it would be personal funds and that's very risky, it's all easier to lend other people's money, isn't it? If you know what I mean.
Yeah.
It's kind of easier. Unless it's your best friend or family members, and then it's worse than lending your own money. um, so there's different perspectives there, so
Yeah, I always like when I look at any sort of investment that we try to bring a partner into, um, I'm heavy on looking at worst case scenarios, and it's maybe just because I've experienced worst case scenarios.
Mm, Me too.
I've gone through my fair share of fires. I've gone through my fair share of people breaking in at the for doing the last inspection prior to closing, and all of a sudden we get told, oh, there's furnaces that are missing and water heaters. So
Right.
um,
Yes.
you have all those hiccups. Typically, that's where most of the deals we would ever share out or try to raise money on. Um, we look at the back end of them too. Hey, this goes the best case scenario. It's showing that we have a profit margin of 50,000 plus. What that tells me automatically is, and that's kind of why I took off 50,000 right off the top down to 275, because it's like, if I gave away all the benefit in this deal, for me, would it still protect another individual that puts their money forward?
Very
And
good.
I have just found that
Mm,
50, anything under 50,000 could get risky.
Yeah.
But usually when you have a larger spread, it's usually more security for somebody investing their money into something.
Yeah.
Um,
You
in the
got the
case
right
of
mentality, Chris. I like it, So, as I say, I'm going to do a deeper dive for us. I've got to thank you for your time. And it's been very good. And to get to know you a little bit better as well, in that and how you presented it. So, I did
yeah, and I think
the
with
presentation as well. I thought you had all the information there. So many deals I get do not have all the information, and so I just had those questions. So
I gotcha. And I think something that I always like to point out when I'm on these types of calls is, on the second page of deals we present, there's going to be a portion of an access calculator. In that access calculator, it's going to break down multiple numbers. Where I try to direct attention to is the interest portion. We do put a generous buffer in there compared to the actual interest we pay out,
mm,
um, on an investment side for an investment gain for an individual like yourself. So when you look at the two, it's like, oh, my investment gains 8250, but the access calculator, it's showing that the investment gain is 17,875.
mm,
Why we do that is we inflate that to give us even more of a buffer, um, which then we take that into consideration, where it's a little under 10,000 for a buffer already, to then give us our profit of, well, it was 54. So best case scenario, we shoot over 60. Worst case scenario, we have that buffer already in there for a rainy day if something does come up, like a furnace goes
yeah,
bad prior to closing.
yeah.
So
And
we
you're
try to,
covered then. Yeah, you're covered.
yeah,
And if you did need the covering, it's a nice surprise. It's something to go out and celebrate with.
yeah. I mean, it's just
Yeah,
it's something to say, hey, something could go wrong. We can still meet our goals. We can still meet an investor's goals if they invest with us. But if everything does go smoothly, then it's just more reward on the back end.
yeah,
So
yeah. And I've seen many rehabs and things fixing flips, and I still haven't come across one where it's actually they spent less. You always spend more, when you fix it. It's inevitable, And
yeah,
so how you
that's
calculate them? uh,
yeah. We honestly, from our perspective, we used to do well. All I've done many different um, purchase strategies. All of last year, we strictly focused on doing fire damaged homes. So that was like the worst case
mm,
of anything coming up that wasn't expected, because it always happened.
right.
Um, but most of this year, we focus on just light cosmetic, sort of novation style deals,
Hmm.
to where we're going in, and it's just it's speed. I think in any flip, it's speed. The faster you can get in and out of them.
That's
Um,
good for the economic climate we're in right now. Where we are positioned in the cycle. There's less risk right now, yeah, because
yeah,
correction's coming. So very soon. We're overdue for a correction, so that's very wise. All right, thank you, Chris, and thank you for your time. I appreciate that. I'll be in touch. All right,
that's
once.
great. Thank you, Graham.
Thank you. All right, bye bye for now.
Bye.